This is Shashank Mehta. I'm the founder of Equity Math, a Mumbai-based firm focused on distributing services of SEBI-registered portfolio managers.
Hi, I'm Ravi Dharamshi, founder and CIO of ValueQuest Investment Advisors.
Mr. Ravi Dharamshi has 22 years of exposure into Indian equities, starting his early days in rare enterprises to becoming a SEBI-registered portfolio manager today. We would want to give a warm welcome to sir. It's a privilege, and we hope to make the most out of this interview and understand what ValueQuest does for its clients.
Thank you, Shashank. And I must say that you are definitely putting in a lot of effort in generating good quality content. Appreciate that.
Thank you, sir. So, sir, to start with, what I know about you is that markets are actually a part of your DNA. We would want to first know how has been your journey so far. What led you to become a portfolio manager in 2010? And since then, how has been your journey? Maybe you could highlight some learnings and wisdom that you gathered along the way. And if you could end that with what do you aim to do in the coming decade?
Shashank, I have very humble beginnings. I am second generation in the equity market, so you're absolutely right. My dad started off as a equity sub-broker way back in late 70s, early 80s. And, he's fought his way up the ladder. And initial days, broking was the way to make capital. And luckily, we got a good phase during the Harshad Mehta boom. So at that point of time, we generated some capital and which we deployed in the market as an investment. And at that point of time, even 1 lakh rupees was a big amount. And my dad bought some shares of Cipla, which was a very, very small company at that point of time. And honestly, the kind of CAGR returns that company generated, if I was holding those shares today, it would have been worth more than 600-700 crores. So that opened our eyes to what are the possibilities in investing. Of course, we didn't hold it. That money was used to buy NSE card, BSC card. It was used to marry off my brother, buy a new house. A lot of things came because of that investment. So once the capital was built, we actually stopped doing active equity broking sometime in 2000-2001. So that was because we believed that the interests were not aligned with the investor, with the clients. Essentially, you brokers make money when there is a lot of activity, there is a lot of churn. While the funda for making money is you have to keep your activity and churn levels on the lower side. So we stopped that. And but there were some few friends, relatives whose money we were managing. That also became very big. So managing money was never an objective for us professionally. But there came a time where we have to take a call that either we do it professionally or we actually return the money back to the investors. But they insisted that we manage the funds for them on a professional basis. So that's where I came in 2010, and we applied for a SEBI license. We got it, and we've been managing money for clients ever since. So we have a 12-year track record today, and over that 12-year, we have generated 20% plus kind of XIRR returns over that period. But honestly, our legacy, of course, is far longer than that 12 years.
So legacy from 1980s maybe to date. What do you aim for the coming decade for ValueQuest PMS?
We like doing what we do, which is pick stocks. We'll look to identify opportunities and make money. The CAGR returns or AUM under management is an outcome of what we are doing, and it is not an objective that we start working with. We are not here to build a business of managing equity AUM for the sake of it. We believe if we grow our clients' wealth, automatically the growth will come. And I don't have to be under any kind of a pressure to reach a certain goal or target in next year, 5 years or 10 years from now also.
They say that philosophy is a culmination of what one has read in academics, what one has experienced in his career, and also fundamental truths that one believes in. I believe that philosophy is like the glue that puts everything or keeps everything together. What is ValueQuest's investment philosophy when it approaches managing a PMS for its clients?
Sure. See, I come from lineage of people who are actually kind of warriors in the markets, or they are street fighters, if you must say. and not people those who have learned their investing in the classrooms of MBA. So what I have seen in action was how I developed my philosophy. And while that was happening, I didn't realize that I was actually developing my philosophy. So our attitude was always to look for opportunities and always to look for ways how to make money. But along the line, you discovered that you tend what kind of companies that you're making money in, what kind of companies you're not making money in. There has always been an evolution of philosophy. How much concentration, what should be the bet size, what kind of sectors to avoid, what kind of promoters to avoid. All that has developed along the way. Today, I can say that our philosophy is to find companies that change scale, that go from, if they are small, they become medium size. If they are medium size, they become large. If they are large, they become ultra large. So look for companies that are going to change scale and the market has not yet recognized it. If that is the case, then that is the time when the returns are the fastest and most sweetest. And this phase usually lasts minimum 3 to 5 years, but it can last longer than that also. So that in nutshell is our philosophy, the framework in which we analyze or we try to understand the opportunities. First, you have to look at what the total market size is. Then you look for companies that are displaying some sustainable competitive advantage, that have a business model that is scalable, and then whether you are getting it at a price which does not factor in the future possibilities. See, usually all philosophies revolve around that only: opportunity size, management, valuations. We try to make sure growth is an ingrained and inherent part of the opportunities that we are looking at.
Just a follow-on question on what you mentioned about philosophy. Has this philosophy been the same from day one, or has it evolved as you got along? Could you share some learnings and experiences that allowed you to shape this philosophy?
Yeah, absolutely. Of course, all philosophies evolve over a period of time. Even Warren Buffett evolved from buying cigar butt kind of opportunities to buying good companies at fair valuation rather than buying cheap companies at cheap valuation. So we also have understood along the way that a sustainable wealth is created through companies that are going to be around 10, 20, 30 years from now, and that are market leaders, have some kind of a sustainable competitive advantage, and that can replicate its success over a long period of time. But in terms of portfolio construction, position sizing, we actually have taken a slightly reverse route to what most people do. Most people start off by being very diversified and eventually move to some kind of a concentration once they develop their confidence. I come from a school of thought where making money was the objective, and when you spot an opportunity to make money, then you don't bet 1% or 2% of your portfolio, but you bet as much as you possibly can. Obviously, we were taking far larger risks than we should have been, but it also evolves along with the time and phase of your life. At a time when there is nothing to lose, you tend to bet big, you tend to have concentrated bets. As you move along, sustaining wealth is different than creating wealth. So you might have created wealth in a particular way, but to sustain wealth, you have to change your philosophy a little bit. So a little bit more circumspection, introspection about what kind of companies to buy, how long to hold, what kind of concentration. So today also we follow a very concentrated portfolio, but instead of maybe 2, 3, 5 companies, we are probably buying 8, 10, 12 companies in our portfolio. So that is how we have evolved along the lines of concentration and along the lines of the quality of companies and size of companies. Today we will not bet on company where we can't see a company making 100 crore kind of a PAT either current year or in a very near future, and that has never had any kind of a track record in generating ROEs greater than 15%. So those are something that you want to avoid, and never align with promoters who do not share their wealth with minority shareholders.
So to summarize about ValueQuest's investment philosophy, if I were to put it this way, as Sir mentioned, that rather than reading books and theories and trying to form an investment philosophy, he's actually done the reverse. He's actually been mentored by warriors like Rakesh ji, Radhakishan ji, Kalparaj ji, and has been able to see things actually in action. and from those consecutive actions that have been taken where wealth has been created, he's been able to draw out live experiences and form his own concrete philosophy of how ValueQuest does things. Also, how it has evolved and how it's been able to change, whether it's the concentration in terms of number of companies in individual portfolio, and also the overall annual PAT numbers, where ROE numbers, where they have to be higher than 100 CR and 15% respectively. Now that we've understood ValueQuest's investment philosophy, if we can go one step deeper and understand that when an incoming client/investor comes to ValueQuest PMS, how do you structure the portfolio? Do you follow a model portfolio strategy, or do you make individual portfolios for each client, and why?
Shashank, even before the portfolios are made, first what we do is try and understand the risk appetite of the client. We try and understand what is the profile of the client. And all this is important because we do not follow a model portfolio approach. We follow a customized portfolio. And we believe that model portfolio does not make sense. You cannot keep buying the same stock at any price. So there are times when certain stocks are in value zone, buy zone, and there are times when the companies are not in the buy zone, and one should be holding on to them, but at the same time not buying any further. And also in the wealth creation journey of a client, what is important is that there is complete alignment between the client, the portfolio manager, and the portfolio. All the three have to be aligned, and there is complete sync. There are certain decisions that client takes: how much money to allocate, when to put, how long to continue staying invested, when to withdraw money. And there are certain decisions that portfolio manager take, which is what stock to buy, how much to buy, how long to hold on, when to sell. Based on that, the outcome is determined whether the wealth is generated or not. So it is very important that the portfolio is customized to the goals and risk appetite of the client. So we follow a very customized portfolio. And in terms of concentration, we have about 8 to 12 stocks in a particular client's portfolio. So that is on the concentration side, because more concentrated than diversified, because we are firm believers in the philosophy that if you want to change your size and if you want to create wealth, and you need to take concentrated bets. I don't want to bet on my 50th best idea if I find a good opportunity. I would rather bet on my top 10, 15 ideas. That's it.
What you explained to us is that ValueQuest manages individual client portfolios. One can imagine that people joining at different points in time would have different portfolios in terms of the stocks that they have and even the weight that each stock might have. What does ValueQuest do so that in a longer time frame, individual client portfolio performance is almost equal to or very near to the ValueQuest's weighted average performance over a 3-year, 5-year period?
It is not an objective that everybody's return should align to the firm's returns. So everybody's journey is going to be different for sure, depending on what point the money has come. But what we strongly believe in is that if I have bought a stock at 100 rupees and the stock has gone to 300 rupees, but I continue to doesn't mean that I still have to buy that stock at 300 rupees. So there is no way for me to keep buying the same stock at all points of time. What we do is we have a focus area of about 40 to 50 companies, and from that 40 to 50 companies, whichever companies are in the buy zone at that point of time eventually end up getting featured in the portfolio. You will not have standard returns, but what you will have is portfolio that aspires to generate positive returns, absolute returns, regardless of the market status.
So for our clients/investors, what Sir just explained is that ValueQuest manages portfolios individually for each client once they evaluate and understand what kind of risk profile the client has. And also in contrast to other PMs where they perform a portfolio rebalancing exercise, here portfolios are allowed to remain heterogenic with an objective of generating absolute returns. Sir, what I know about PMs is that there are these two different schools of thought where some portfolio managers believe in remaining fully invested at all times, while some PMs believe that there should be an element of timing in the market. What should an incoming client or investor do? Should he try to time the market, or should he shift the burden of timing the market to the PM? What is your view on timing while creating a portfolio?
No, I think, Shashank, again, I come from a slightly different school of thought. While most would profess that what is important is time in the market and one should not try to time the market. But if I were to give you an analogy of driving a car, what you need to do is understand when do you press the accelerator and when do you apply the brakes, or at what point of time you just keep chugging along. So that broad understanding has to be there in terms of what stage of the market we are in. You don't try to precisely time the market bottoms, but at the same time, you don't want to make the mistakes of getting greedy at absolutely wrong time and getting fearful at absolutely the wrong time. So even though most of the returns get generated when the markets are rising, but what you do at extreme points, your decisions at that point of time do play a large part in the alpha that you generate. So it is only to the extent of not making a mistake is that we would like to time the market. Otherwise, absolutely nobody should try to time the market. One has to stay invested for the long period of time. If one was to do that, there is no way you can lose money.
So, sir, this is a follow-on question. While we understand that you explained that investors may remain invested for the longer term, but that there is an element of timing and to know when to press the accelerator and when to ease off. Could you share an example or two in the sense that when you decide to take a certain weight in a certain stock, let's say you decide to take a 12% weight or an 8% weight in a certain stock, how do you decide when to build that weight? Do you do it at one go, or is it done in a staggered way?
So first let me expand on the market side, the market timing side, then I'll come to the stock specific weightages that we take. So March 2020, when COVID struck and the whole market was panicking, that was one point of time where I really felt that market is giving an opportunity of a lifetime and one should be really pressing the accelerator. It's not like I knew what was going to happen in the next 18 to 24 months, but it is there to see the kind of opportunity it was presenting. What we do is try to assess the odds, and the odds were extremely favorable at that point of time. So that is what I mean when I say timing the market. And from the point of view of again, it is a play on if an opportunity, management, valuations, all three are in favor, you go ahead and take the maximum possible bet that you can take. If 2 out of 3 are in favor, let's say only the management and opportunity is in favor, but valuations are not, then you take a smaller weight and you wait for an opportunity to when the valuations come in your favor, at that point of time you can increase. Or if you believe that the company's the narrative and the execution is panning out better than what you expected, then that is the point at which you increase the allocation. It is nothing to do with the price movement, but it is everything to do with your conviction and confidence in the company delivering on whatever the future story is.
So for our clients/investors, ValueQuest's view on timing the market or timing of creating the portfolio, ValueQuest's view is that while over the longer term remaining invested is imperative, but there is an element of timing, and as sir gave a very good analogy to understand about a car and its acceleration, you know when to press the pedal. And that is what ValueQuest also does while creating a certain position in a certain stock. When they decide a certain target weight, they do look at the overall market scenario, and they do have experience and proven track record that they have pressed the pedal and it has paid off. And that is what they intend to repeat. Sir, what is ValueQuest's investment universe? Rather, what is really the starting point? Do you have radars that are set up where you get pops and you start taking interest in a certain company, or are there screeners that you have? Because it all looks like trying to find a needle in a haystack. So what's really the starting point that gets you interested in a company?
See, there are many listed companies, 5,000, but for all practical purposes, 500 to 600 companies is what really are worthy of your attention. That's the whole universe we have. We absolutely ignore the rest of it. That 500 companies list, we have arrived quantitatively as well as qualitatively based on the size in the industry that they are operating in. We try to make a list of companies that are leaders or challenges in that space, and we will not go too much below that curve. And from that universe, then you try to apply quality filters and see which 150 to 180 companies match those quality filter. And those quality filter basically are the basic hygiene factor in terms of the kind of gross margin, the value addition the company is doing, the cash flow that it is generating, is it meeting all the criteria in terms of indebtedness, return ratios. Based from that universe of quality companies that you came up with, see where the growth is prevalent. As I mentioned earlier, that growth is very important to us as a philosophy. So then you want to apply the tailwind criteria. Which are the sectors that are witnessing the tailwind? What we believe is that your odds of making money are almost close to 1 if you are invested in a sector that is witnessing tailwind. While if you want to invest in companies which are doing well within a sector that is not doing well, you will have to be very, very sure about the stock that you are picking. So the odds over there are slightly on the lower side. So our assessment of the sectors that are going to do well is the starting point and where we will start looking. So it's a combination of top-down and bottom-up approach. Top-down, we will look at themes, sectors that are going to do well, and from bottom-up, we will try and understand which are the companies that are positioned to take advantage of the emerging trends, which have the right to win in that. And that is how we reach a portfolio of about 8 to 12 stocks from the distilled list. We let the growth story pan out over the next 3 to 5 years rolling view. So we don't take a 10-year view, we don't take a 1-year view as well, less than 1-year view. We try to take a rolling 3 to 5 years view because we believe that it is not possible to know what is going to happen 5 years down the line. It is only with reasonable certainty can you make an educated guess about 3 to 5 years future. So, and you keep reviewing that at all points of time. You keep building your conviction and again that whatever you thought was the scenario is actually panning out, or if it is better than that, that you continue to hold. But in case it is not, then you need to take a hard look and maybe even exit if the hypothesis is not panning out.
What we've understood is how you take a broader look on a top-down way when you look at sectors that are observing tailwinds, and from a broad pool of 5,000 companies, you might have a coverage on, let's say, 55 odd companies. What we would want to know is, when does a company that is in your coverage or a shortlisted company, when does a shortlisted company become a portfolio company?
So there are many trigger points that we have identified, whether it is a management change, there are whether it is deleveraging story panning out, or whether there are slow changes happening over a long period of time in terms of business quality improving. Has the management shown good ability to manage balance sheet in a downturn? All those things brings the company on our radar, and then we wait for those points in time where we believe that odds are in our favor, or that the growth story has started panning out, or the some catalyst triggers that we have identified are playing out. That is when we bring the company into our portfolio. So just to give you an example of a company, there's a company called Laurus Labs. I have known the promoter since over 15-20 years. In its earlier avatar, Mr. Chhava Satyanarayan was a COO in a company called Matrix Labs, where we had invested way back in 2003-04. And I always knew that he is an ambitious person and with a very good technical knowledge. He actually left Matrix Labs, he joined a business school, upgraded his skill and started a company. And I had been tracking the company on the private side. It was known as Aptuit at that point of time. So they got in private equity and they continued to do well. They completely dominated entire retroviral API space. So when that company came to the market, it immediately came on our radar. But the growth that we were anticipating was still some time away. The new capacities were getting put in place, and there would be a transition period, and the ability and the demonstration of the margins to improve was still not very sure. So once we had a couple of quarters of demonstration that the margins can improve, that is when we placed our bets on that company. And this was in the month of April, May 2020. And luckily we got it at a valuation which was very much in our favor. And the kind of profit growth that we witnessed in the next 7-8 quarters surpassed our expectations by a huge mile as well. So many a times we keep tracking a company for a long period of time without placing any kind of a bet, and we wait for the picture to become very clear that this is a stage from where this company can change scale, and that is precisely when we would like to place our bet.
Sir, given that ValueQuest follows a concentrated portfolio strategy with anywhere between 8 to 12 stocks, how do you decide the target weight? Is it linked to your conviction or is there a math behind it?
As I mentioned earlier, yes, we have three different types of bets that we would place. Either it's a 15% kind of a bet where we know we have all the three aces in our favor, management, valuation, business tailwinds, everything is in favor, and it's an opportunity that we should capitalize on. Then we can go as high as 15% kind of weightage. If we are unsure of one of those things, then we would take a 10% kind of a bet. Where the valuations are a little outside our comfort zone, where maybe we are paying up for 1 year, next year's growth, but the company is good enough for us to have it in our portfolio. It's a must-own company. Over there, we would take a smaller weightage of 5%. So broadly, that is a very simplistic science behind what kind of weightage that we take. And anyway, we don't take any bet that is less than 5%, and we don't take any bet that is more than 15% at the cost level. Even stock that does well, let's say we take a 15% weight and does so well that it becomes 25% of the portfolio, that is at the point of time at which we might start reducing it also. We don't want to have one stock determining so much of the outcome of the portfolio.
For our clients/investors, ValueQuest has a very interesting way of how they create a pool of companies that they are interested in, from 5,000 to literally bringing it down to some 50-55 companies on which they have coverage. Not only that, they've been tracking these companies for many years, or in some cases even over a decade. And what they do is they essentially wait for certain triggers, that could be growth catalysts. And the moment the trigger is hit, a certain company would, from a shortlisted company, become a portfolio company. Also, given that they have a concentrated portfolio strategy, if they believe that they see a company hitting aces on all three counts, they might take a weightage as high as 15% in the portfolio. In no case a company has weightage of less than 5%. Also, when a certain company outperforms, and as sir mentioned that let's say it shoots up in value to a 2x or a 3x, it may happen it will become like a 22 to 25% of the portfolio. They don't mind shaving it off and bringing it down again to 15% and investing that money into some other similar company. Sir, in this neo world, I really believe that there is no buy and forget. In fact, I rather believe that there is an appoint and forget, appoint a SEBI registered PM such as ValueQuest and forget. The question is more tilted towards the holding period. How do you really decide about holding period of a stock? Rather, what would trigger a partial or a complete exit from a stock? If I have to make it slightly more dramatic, when does Ravi Dharamshi press the sell button?
Good question. Sell is the most difficult decision, but the most often used decision is the hold. So yes, at some point hold decision does convert into sell. But to answer your initial part of your question, you are absolutely right. Every 10 years, the companies that generate wealth, the top 10 list keeps changing. That tells you that no portfolio can remain complacent, or you cannot buy and forget. These are not the times. There were times in 1970s, 80s where the best of the blue chip FMCG company you could have bought and forgotten. And stocks that were forgotten for 40, 50 years are the one that generated a lot of wealth. Surely you can do that, but that limits you to a very limited number of companies, would be 20, 30 companies in India. So you cannot possibly do that with every other company. So you have to have a rolling view. You have to keep evaluating them. You have to actively take a look at what are the risks that are emerging for the industry, for the companies, whether the company is gaining or is the moat is eroding. So you have to constantly evaluate. From sell perspective, we take a sell call either when we believe that this company has reached its full valuations from the next 3 years point of view, and I cannot justify to myself this company doubling in value over the next 3 to 5 years. That is one. Second is, of course, when your hypothesis goes wrong, and whether that is because hypothesis didn't pan out, or whether it is something at the part of on the part of management or company that led to execution challenges. So those are the point at which you admit your mistake and exit. The sooner you admit your mistakes, the better it is. Constantly you have to keep weeding out bad companies from your portfolio and keep adding good companies to your portfolio. So yeah, sell is a decision that we loathe taking if we have gotten the investment right. But at the same point, you cannot rest on your laurels and be complacent. Do a critical evaluation at all points of time.
So for our clients/investors, just to reiterate that even sir agrees that gone are those times where you could buy a company and forget it for 10, 20, 30 years. Doing a quarterly review is a must, and holding a company is a decision that you take after doing a quarterly review. But if you don't want to get into all this and shift this entire burden, appointing a SEBI-registered PM such as ValueQuest might just be the most prudent thing that you could do. What I understand from what you've explained is that ValueQuest is market cap agnostic. But sir, the cap mix in a portfolio defines how bumpy is going to be the journey. Any skew towards small cap could mean higher peaks and higher drawdowns for a client. So for an incoming client/investor, if one wants to understand, what could he expect? What kind of cap mix would he expect with ValueQuest? Any comments on that?
The drawdowns from the peak is more a volatile. That's the nature of the market. One has to be prepared. So we are market cap agnostic. We have all three schemes which are multi-cap. By focusing on a particular set of market cap, we were missing out on a lot of opportunities. Sometimes some companies do well from various brackets. So why do you want to be only invested in companies where there is only a seasonal kind of performance? What we instead try to do is identify companies that are dominating or gaining market share in the particular pond or ocean that they are operating in. So what is important for us is not only the size of the pond, but also the size of the fish in that pond. And if that fish is dominating that pond, and if the management has shown capability to keep moving from smaller ponds to bigger ponds and execute and manage the balance sheet along the way, then that is what we want to do. Every large company in this world was a small company at some point of time. So why not identify and bet on them early enough? Of course, your odds are very different when you are betting on a young company. It's not a guaranteed success. But to give you an example of Bajaj Finance, in 2010, it was pretty much a mid-cap company, if not a small-cap company. And today it is one of the largest cap company. So institutional imperative would have made sure that a lot of institutions don't look at it until it became large. But the real wealth has been created by people, those who identified it early enough and sticking through it, through the drawdowns. The durability of your returns is coming from the quality of your company, the quality of the execution of the management, and it is not coming from the stock price movement. It is very important that you focus on what is happening in the business rather than what is happening in the stock market. Stock market is a giant distraction to the business of investment. So do not make assessment of the risk based on what the stock price is saying. One should focus on the business. If the business is doing well, the stock price will eventually take care of itself. We do not believe in having any kind of a technical stop loss or taking calls based on price movement. You have to focus on the business and what is going to happen in that. If you believe from any point of time, we have to have the conviction that in 3 years' time or 3 to 5 years' time, this company can double its profits, then your returns are pretty much okay. The journey from 100 to 200 can never be in straight line. It will have its drawdowns. One has to be prepared for that. One has to live. It's a feature of the market and it's not a bug.
Just to reiterate what sir said about his views on market cap or the cap mix of the portfolio, while ValueQuest definitely has a view that it chooses to remain market cap agnostic, but sir has also given a very, very interesting analogy, almost like a holy grail, that not only you need to find fishes that are going to grow big in a pond, so from a small it becomes a big fish in a small pond. Not only that, but it also has the ability, so the management of the company has the ability to execute their success stories so that they switch into other ponds and also become fishes that becomes big across ponds. I hope I have worded that correctly, but sir, gave an example of even Bajaj Finance for that matter, which was just a mid cap back in 2009-10. But by remaining market cap agnostic, you might end up buying companies like Bajaj Finance. Again, this question is more on what price do people pay for growth companies, how they'll keep looking for value companies. Again, different schools of thought, but what is the mix that ValueQuest looks for between growth and value? And are these schools of thought actually there? Do you even believe in such a mix, or do you have a different take on this?
It's better to not get caught up in the nomenclature or label yourself as value or growth investors. You would rather focus on an opportunity to make money over the time frame that you are looking at. 3 to 5 years is what we look at. So your alpha can come from the fact that you bought something that was worth $1 at 50 cents, or it can come from the fact that you bought something that was worth $1 at $1, but the future value of which could turn out to be $5. So both the philosophy have a component of growth inbuilt in them. Instead of assigning any kind of terminology, focus on the philosophy of buying companies where you can make absolute returns over next 3 to 5 year period, essentially, which is doubling. Just to give you an example, a lot of people also give weightage to the PE multiple. Nothing wrong with that, but it is only a particular tool. The way we look at a company or an opportunity is what is the size of the opportunity versus what is the size of the company, and what is the right to win or their ability to capture that particular market. So just to give you an example, if there is a company addressing a 50,000 crore market and it is only 1,000 crores in size, and it has all the ingredients, the management, execution, balance sheet, and the ability to capture that market, even a 15-20% kind of a market share, then you know that your margin of safety is coming from that rather than buying at a P multiple which is small. It's a absolute size of company versus the size of the opportunity that is addressing, and that is where the margin of safety lies.
What sir just explained about the mix between value and growth, a very interesting but a very different way of looking at things. What sir looks at is पैसा कहाँ बनने वाला है, and more so does that company have the ability to execute the plan. So opportunity to make money, the size of the company versus the addressable market. So that is where he sees margin of safety, and not the conventional thought process where something is available at a lower PE, which means that it could be having a certain margin of safety compared to the intrinsic value of the stock. So those are not the only parameters that ValueQuest looks at. There are a few more parameters that sir explained that they look at before they choose a company, and they don't also go into labeling companies whether they're a growth company or a value company. So few in the market also believe that turnaround companies are dubbed as multi-baggers. What is your view on turnaround companies, sir? Does ValueQuest invest in turnaround companies? And typically, if yes, what would you look at, and what kind of weightage do you give it in the portfolio?
Turnarounds are exceptions. Businesses seldom turn around. So one should not have a turnaround heavy portfolio in the first place. Having said that, there are times when turnarounds do happen. One should not bet on management changing its stripes. One should not bet on balance sheets that are beyond repair. What one should focus on is where the quality of business is very good, but it is undergoing a prolonged cyclical downturn. Those turnarounds tend to pan out. So the basic economics, the basic strength of the business has to be there. The management has to be above board. And then maybe because of the prolonged downturn, market is giving you an opportunity to buy it at a cheap valuation. And if you can identify triggers that will lead to the change in the perception that has been built because of the recency bias, that is where you will make good money. We won't bet more than 20% of the portfolio on such companies, even though good money can be made over there.
Sir, we understand that ValueQuest invests across sectors, across market cap, but is there a negative list sectors or subsectors that you avoid, or certain company managements that you avoid? Also, could you talk about red flags that pop up which make you basically drop coverage on certain stocks?
So Warren Buffett has explained it very nicely when he says you should stick to your circle of competence. But most people interpret it in a wrong way, that you should not invest at all, or you cannot expand your circle of competence. Even he never invested in technology companies, but then eventually he did. So that tells you that you can expand your circle of competence. But that is a more positive way of looking at it. The more negative way of looking at it is basically making sure that you don't venture in gullies where you can end up losing your capital. So do not bet on managements that have taken actions in the past which were detrimental to the minority shareholders. Do not bet on a huge debt on the balance sheet. Anything more than 2-3x debt to equity, one has to be very, very careful on betting it. There has to be a very clear path to deleveraging of that balance sheet, then only you should even consider it. So, and there are obviously the basic quality of the business has to be there. So I would say besides that, there are many red flags that one should avoid. We have a very good management evaluation framework where we try to assess the management on three things. One is the integrity of the management above par, above board. So over there what we try to see is whether the cash flow accounting matches the P&L accounting, and if that does, then we hold that. And also the proof of the numbers is usually lies in the cash flow, the dividend, the tax payment, and where the money is going. That will tell you a lot about the integrity of the management. Second is try and see whether your interests are aligned with the management. How do you do that? There has to be skin in the game. There should not be other businesses. There should not be other smaller companies where the management is focused. So if your interests are aligned with the management and the promoter group, then you are in good space. And then the third is obviously the capital allocation, which is the big one. How have they utilized the cash that they have generated in the past? That will tell you where that money, whether they are going to share it with the minority shareholders, or if there are opportunities for reinvestment within the business. That is where you are going to make your returns from. If the management meets all the three criterias, that is where you should be betting on. So besides that, there are some industries against which we have some biases. We don't try to time the cyclicals, because you have to be very sure of your entry point as well as the exit point, and you cannot get that cycle wrong. Having said that, we will not say that we will never invest. You have to buy cyclical companies at asset value and sell them when they are getting valued for their earnings. But we have our biases against those. We will not venture down that road very easily.
ValueQuest's negative list is more to do with the PM avoiding companies whose management has had a track record of taking actions that are detrimental to minority shareholders, or be wary of companies where the debt to equity is 2:1 or 3:1, and where there is no clear path of deleveraging the balance sheet. More so, they also look at management from three angles. First being whether the management is dedicated to the business that they are into, or do they focus on more than one companies and more than one businesses. Second is how have they allocated capital, the cash that they've generated in the past. So second is capital allocation, and third is integrity in reporting numbers, so which is typically tested by cash flow accounting. Sir, while India rallies itself to a 5 trillion GDP economy, there is this disruption coming in from technologies and which is fairly rapid, and the magnitude of impact on different sectors is also very, very different. How do you track what's happening in technology such that it does not create any disruption for any of the existing portfolio companies?
You're absolutely right. This word called disruption risk did not exist in the books of most of the investors maybe 10 years back. So today it is something that one has to keep evaluating at all points of time. And disruption can come from quarters that you did not imagine. For example, earlier Mercedes used to compete with Volkswagen and other companies, car companies. But today, Tesla and Apple could end up being the competitor to Mercedes. So disruption can come from any place. So what we do is we track the startup space as well from the point of view of investing, and also from the point of view of risk that it can pose to the listed space. So we are actually looking to launch Cat 2 private equity fund, which will address the market which is pre-IPO growth stage, where companies that have crossed the valley of death and are at a stage where they can do a cut, copy, paste and replicate their success in a particular area, and can identify adjacencies and move in concentric circles to create value, and where the unit economics are in place. The only way to play the disruption is to identify who is the one disrupting. And if you find a company that is disrupting, then you will know which are the companies that are going to get hurt. And this is a risk that is very difficult to identify. Only way to do it is find companies that are disrupting.
With respect to technology disruption, I think Ravi sir or ValueQuest has a very interesting take. They have applied for, to start a PE fund under Cat 2, which is basically a SEBI registration process, AIF under Category 2. That's the full form of Cat 2. Where they would be focusing on companies which have just crossed the valley of death. That's again a term that typically private companies use to basically point out that not only the proof of concept is delivered in terms of the business potential, but also they are now at a point where they are, so to say, successful but not yet public listed. And the whole idea would be to also find out who are really these disruptors, because once you know the disruptors, you also know whom are they disrupting and where to invest in. So that's their shield that they would use to understand how technology disruption may impact one of their portfolio companies. Sir, I was going through ValueQuest's website like any other incoming client/investor would do, and I came across these three quotes were very, very interesting and might have a deep meaning. But could you throw light on these three quotes? The three quotes were as follows: wisdom to see, fortitude to hold, and courage to capitalize.
Shashank, today I can tell you what I am buying, but that will not give you the same vision, what I am seeing. What is that company going to become over the next 5-10 years? You will not be able to see what I am seeing. Even if I tell you what is it that I am expecting this company to become over the next 5-10 years, you still need to understand what kind of allocation I am doing. And that allocation will depend on the confidence that I have. And then besides that, you also need the fortitude to hold. If you are looking to aspire to buy companies like Bajaj Finance and Titan and hold them for 10, 15, 20 years, you cannot do that without drawdowns of 30, 50, 70%. So you need the combination of all three. And this cannot be borrowed conviction. It is something that you have to develop on your own. All three things are necessary for you to create wealth in this market. I'll just expand on the example of Titan. Titan used to be a 300-400 crore market cap company when Rakesh Jhunjhunwala was buying back in 2002-3. And today it is more than 2.2 lakh crores. Do you think this happened without any kind of drawdowns in this market? We have witnessed global financial crisis, we have witnessed COVID bust, and there have been many other drawdowns. Titan itself has undergone more than 30% correction almost 7-8 times, and it has undergone more than 50% correction twice, some of them lasting as big as 80%. Imagine holding 10% of the company. Imagine holding 30% of your portfolio in that kind of investment. You think you'll have the wherewithal to hold it through a 80% drawdown and have, so you need to have the vision to see what is going to happen. You need to have the courage to bet on it, and you need to have the conviction and fortitude to hold through the ups and downs of the market. That is when you create real wealth.
Wisdom to see, fortitude to hold, and courage to capitalize. Three mantras, I would say, really important for a lot of people out there, potential clients and investors who believe that they might be able to do what a PM does, even if they know what companies a certain number of PMs are invested in. What really matters is, would you be able to hold a company such as Titan for a period as long as 10, 11, 12 years, during those drawdowns especially, would you be able to do that? Number two, would you be able to give a meaningful allocation of your net worth to a certain company? Would you have that kind of a conviction that you would be able to give a 15% to maybe a 30% allocation to a certain company? Well, it's difficult to say. Also, what I would want to add is to constantly review the business of a company. It's almost like a full-time job. While sir has explained this in a way, and it sort of forms a part of ValueQuest's philosophy or something that they've acquired over the years. So they have the wisdom to see, they have the fortitude to hold, and they have the courage to capitalize. Sir, let me conclude with one of the most common questions but a necessary one. What is ValueQuest's outlook on the market from here on?
Instead of an outlook, what I will give you is that investors should come to the market not with the intent of creating income, but with the intent of generating wealth. That needs attitude, which is far more patient. One needs to have faith in the market. Yes, there will be drawdowns, there will be wars, and everybody will be scared from time to time. But those are the times when you get good prices. So if you build your portfolio when times are a little uncertain and volatile, then your portfolio is likely to do very well over a long period of time. We are going through one such phase in the market where we are not sure how the war will pan out, what is going to happen to the inflation, how are the interest rates going to pan out. But that precise uncertainty is what is giving the market investors an opportunity to build a good portfolio of companies with the next 3 to 5 years point of view. All these things will matter in the next 3 months, and they will be forgotten over the next 3 years.
Sir, I had also gone through a presentation where you have summarized what you see India's future for the next 6-7 years. Could you throw some light on that and help us understand what could be the major growth drivers for India from here on?
So what the title of that presentation was, Indian Economy Stronger for Longer. And essentially what I am trying to say is that the conditions have never been so favorable for Indian corporates in the lifetime of since the liberalization. The liquidity conditions are good, balance sheets are deleveraged, banking system is robust, forex reserves are on a high, government focus is absolutely on giving incentive to scale. This is a big thing. A lot of people underestimate what has happened. It is the first time in the history of India that government is incentivizing scale, become champions in the world. And I think the result of this will exactly be that. We will have companies that will be globally competitive very soon. This PLI scheme essentially does that. It changes the mindset. If people look for growth, people will look for size. Till now, we have disincentivized growth. We have always given incentive to stay small. So that is a change. And then, of course, on top of that, we are giving them protection from Chinese, and the opportunities are opening up in terms of China plus one and ability to export to the rest of the world. So this is India's moment or the window where we should actually capitalize in terms of manufacturing, in terms of energy transition, and in terms of digitization. And we have the opportunity to do that. And India's economy will not only be 5 trillion but 10 trillion, and a lot of wealth is going to be generated over the next decade or so. One should focus on identifying businesses that are going to benefit from this.
Any key message that you would want to send out to potential clients / investors out there? Any few words of wisdom to them?
Come to the market with the correct attitude of creating wealth, not with the attitude of generating income. Avoid making basic mistakes like getting carried away at the peak of the market or getting fearful at the bottom of the market. And have a longer term perspective, and I'm sure there is no way that you can lose money in this market. Having said that, if you don't have the time and inclination to study the market and track it on a regular basis, then give it to a professional who does it for you. You will not regret it.